Good afternoon, everyone, and thank you for joining today's webinar on year-end planning opportunities. I'm Jim Scally, Managing Director of Heritage Financial, and joining me today is Ed Jastrem, the Chief Planning Officer at Heritage Financial. Before we start, I want to quickly mention a few logistical items. First, if you have a question, please type it into the Q&A section below. We'll be monitoring questions throughout the discussion, and we'll do our best to address those questions as they come in throughout the session or prior to the end of the webinar today. Second, financial planning is very personal. And while some of these strategies apply broadly, not all of them may apply to you. So if you have a personal question, please feel free to reach out to us or your wealth management team, and we'd be happy to discuss them with you after the webinar. So with all that being said, I'm pleased to introduce you to Ed Jastrem. Welcome, Ed.
Thanks, Jim. I think this is a good time of year to hit some of these topics. We've got a couple of months left before calendar year ends, so just enough time to take some action before the year's out. And also a good time to maybe set the stage for some planning opportunities for early next year. Should we get started?
Yeah, I'd love to get started. I'm looking forward to hear what you have to say. As I like to tell everybody, you're the guru of financial planning. So everybody's very fortunate to be on this webinar today.
Thank you, Jim. That's a very kind introduction. So the theme today is, around year end, but really it's opportunities not to be missed. So we've carved off a few different planning topics into some key areas, and then we're going to dissect those areas with a few details and talk our way through and see what we come up with for some strategies before the year's out. The first major area that I wanted to cover and talk with you today was just about kind of big picture financial goals and priorities. And we broke that out into a few topics that I think are good to revisit this time of year. Like I said, there's still some time before year end to take action. And it's also around the time of year where we're thinking about the holidays and maybe already making plans for next year. The first parts of that, you could really bracket together the goals, accomplishments, and recommendations. I think are kind of one piece that all those fit together. And if you think about how we talk to our clients or prospects, and what we go over during a regular review meeting and the agendas that we prepare for meetings, I think goals, accomplishments, and recommendations is the framework that we use on a regular basis. We're talking to our clients about what their financial goals are. We're talking to them about the accomplishments that we've done with them or that they've done on their own to try to meet those goals. And some goals are short-term and finite, and they just require one accomplishment. Other goals are longer-term, and they might take years or looking out far into the future and really represent a series of accomplishments. And then along the way, we're coming up with recommendations and trying to make more of those goals things that are completed. And as much as we're driving that process as the advisors and as the expertise in the field, I do think it can be important for persons to review these things on their own, because sometimes goals can change, your circumstances might change, you might want to reflect on your accomplishments and let your advisor or other professional advisors know how do you feel about what you've done so far this year. And if there's recommendations that are still kind of floating out there on your to-do list, maybe you need a reminder from your advisory team about what the purpose of that recommendation is or what the benefits are. So, like I said, as much as we're kind of driving those three things with a lot of our regular client meetings, that can be a really good idea for a client to pause and revisit those things on their own and maybe come back to the advisor on the relationship and just make sure that everyone's on the same page.
Ed, it's a great point that you mentioned. As part of the financial planning process, you may remember this from your CFP days or your CFP studies, which was many, many moons ago. But one of the last processes of the financial planning process is monitor. And a lot of times people may have a great plan, a great investment allocation, may think they have all of their goals on track, But if you're not monitoring that plan on a regular basis, things can go awry, and you just want to make sure that you're always paying attention. And part of that has to do with either meeting your wealth management team on a regular basis or setting time aside to constantly review what you've laid out.
That's absolutely right. And I think the other part of that is, in addition to just monitoring your plan, monitoring your priorities, especially with new relationships, with new clients where we're maybe digesting a lot of material all at once, or when there's a transition. If you're approaching retirement or you're moving, there could be a lot of things up in the air. And sometimes you just need to decide what you can realistically accomplish and what needs to be put on hold. So getting that all together really makes sense. Yeah, let's keep moving forward. Communication is the last point on this. I think that speaks for itself. That goes not only with your professional advisors, but with your spouse, your partner, with your family. So let's just make that the important takeaway from this is communicate with everyone about what your goals and priorities are.
Great.
The second big picture item I wanted to cover with you was about savings, expenses, and debt. And let's break that down into a few pieces. The first being your cash reserves. Whether you call that your emergency savings or just your savings, it's a good time of year to take a look at what's changed during the year. Have you kind of run down what you're comfortable with cash on the side because of expenses and you need to work on replenishing that? Or do you have excess cash reserves that could be put to better use?
Ed, sorry to interrupt you. Real quick question. We get this a lot in regards to emergency cash reserves or how much people should keep in that emergency cash reserve bucket. Is it very client specific? Is it a simple rule of thumb that people should consider keeping in cash reserves? What's the answer there?
Yeah, common question. I think definitely it's person to person. It can be very individualized based on your situation. There is a rule of thumb that exists, and if you look at our financial planning textbooks, it'll tell you what that is, and it's typically 3 to 6 months worth of expenses. But that can vary so much from person to person. If you think about a single income household versus a dual income household, someone who has very high recurring obligations, if you have multiple mortgages with multiple properties and multiple property taxes, if you have kids who are dependent on you, if you have a job with very secure income, or if you're self-employed and maybe have irregular payments. So it can really vary. We have a blog post article on our blog about that hits on kind of some of those other factors that maybe you could use to decide what you're more comfortable with. But really something that's a good conversation to have with your wealth management team to find out, where you might be more sensitive to that or not in your plan. So
Thank you.
Great question to bring up, and it is a common one. The other part that goes along with that is once you're comfortable with the amount of cash savings that you do have set aside, is it in the right place? Are you getting a fair yield on those savings set aside? And for a long time, this wasn't really a topic of discussion because yields across the board were so low. There really wasn't much of a missed opportunity anywhere, no matter where your money goes. But that's really changed just in the last year or so. And the difference in bank account yields from bank to bank and account to account is really quite dramatic. And, this is one of these kind of low hanging fruit. And, we started out saying opportunities not to miss. I think this is a fairly easy one. And we have a graphic just to help talk about this. This is a snapshot from the website Bankrate. That's a site that just keeps track of a lot of information about mortgages and savings accounts and credit cards. And the takeaway from this is if you look at the kind of bottom right of this graphic, it has the national average savings account rate of 0.57. So that's a lot higher than the 0.01 or 0.1 that a lot of us were seeing a couple of years ago. But the point being for this is that even though the national average is 0.57, there are several ways to get much higher than that. today. 7, 8, almost 9 times higher than that. And doing so with the same level of risk. I'm not talking about a money market fund or a bond fund. I'm talking about true bank account, FDIC insured savings. There are savings accounts that yield more than 4%, more than 4.5%, even 5%. I personally recently moved a small amount of savings from an account that was 4.25% to 5% with no minimums and no fees. So this is an area, like I said, the low-hanging fruit. If you're not setting aside savings, if you don't have your emergency fund and account with yields in those upper reaches, that's a really good topic to bring to your wealth management team to find out what opportunities might be good for you.
Ed, real quick, just if you wouldn't mind letting everybody know the FDIC insurance limits as it pertains to banks and registration on accounts.
Those have changed quite a bit recently, and it can really be something that you have to take a close look at based on how you have your accounts set up, whether they're individual or joint or in trust. But it's possible now to arrange something where you can get up to a couple $1 million of FDIC insurance. So that might be another good topic that if you're concerned about it, if you have a large amount of cash that you've set aside for like a short-term expense, if you're buying a home or you have money that you haven't put to work in the markets yet, something that your team could help you assess. And there's even tools with the FDIC website where you can plug in kind of a mock-up of what your accounts look like in the ownership structure and try to double check that you have the right coverage. So something else that is a good topic, I think, to cover with your wealth management team at the same time of looking at the yields that you're getting.
Great.
That all ties into year-end expenses. I know for me and a lot of others, the year-end tends to be when you're doing a lot of gift giving, maybe buying gifts for yourself. You might be doing more charitable giving. There might be some year-end bills. So that whole conversation of your emergency reserves, the yield that you're getting on your bank account, everything else, I think that's all just kind of part of the same conversation. And I think that dovetails into high interest debt. That's something that, the higher yields you can get in your savings and the higher yield on debt go hand in hand. So a lot of our clientele and people that we're working with took advantage of a period of low interest rates and locked in low fixed debt on mortgages that's very attractive. But there's still variable rates out there that can get higher if you think about, for instance, a home equity line of credit, typically a variable rate. And a few years ago, those rates were 1%, 2%, 3%, but they've moved up quite a bit. So just something else to keep an eye on. If you've been comfortable in the past several years with that type of debt because it's been so low, good idea to take a look at your whole balance sheet and kind of see what's going on there. Bonus income, same thing with year-end planning. If you get paid out a year-end bonus, or if you're compensated with options or a stock structure like RSUs, kind of take that into account as it fits into, are you using that for year-end expenses? Do you need that income to replenish your cash reserves? Again, I think this is all part of one big conversation just about the cash that you have on hand and how you're going to use it heading into year end. The last piece on tax payments, really I'm just thinking about if you're on schedule to pay quarterly estimated taxes, the last quarter for 2023 is actually due in January of 2024. So as you're mapping out expenses, income, putting money aside, just don't forget that you might have that tax payment a couple weeks into January, and don't lose sight of that just because it doesn't happen before December 31st. And all of this is in the name of kind of avoiding unpleasant surprises, that surprise of the bill being due, the tax payment that you need to make that you forgot about, having to borrow money at a rate that you don't want to, having to sell securities and pay taxes on gains if you didn't plan ahead. And these are all things that we just try to keep tabs on to the best that we can. And all make sense to look at before the end of the year.
Perfect, Ed. Before we move on and talk about everybody's favorite issue, taxes, or maybe I should say, better yet, how do we try to reduce the income taxes that we pay? We did have a question that came in, and the question to you is, does Heritage have a solution for higher yielding cash accounts?
That's a great question. There's a few different solutions. It might depend on the balance, and it might depend on the entity, whether it's an individual or a business account. But we do have a relationship with a firm that is exclusive to advisors and clients of advisors that currently yields up to 5% for savings, no minimum, no fee. That actually is the account that I moved money to myself, and we've been introducing that to clients just recently. So if that is something that is of interest to audience members on this now or in the future on our recording, please ask your wealth management team about it, and we can get you some more information or invite you to it. And I think that's a really good solution for our clients that have savings that they want to set aside and get those higher yields on.
Great. Thank you, Ed.
So our favorite topic, or one of our favorite topics, as you mentioned, tax planning before year end. So,
and it's only our favorite topic if we can help reduce them.
Well, that's usually the case. If we can't reduce them, I think just being more tax aware, right? If there isn't a strategic opportunity to lower the impact of taxes, I think we need to at least be conscious of what the liabilities might be. So that might be the best we can do in some instances. But again, if we can avoid surprises, all the better. There's so many underlying subtopics to tax planning that we can't possibly hit them all on a chat over the lunch hour today. So, we picked a few that we thought made sense to cover this time of year. With retirement plan contributions, the big distinction, I think that's important, is to remember that for IRAs or Roth IRAs, you have a little bit of leeway. If you haven't already made a 2023 tax year contribution for an IRA or a Roth IRA, you have until April of next year. So I don't want to encourage anyone to procrastinate, but if you're still figuring out your cash management, like the last slide, then you do have a little bit of time. But with your employer plans, like a 401k or a 403b, those are calendar based. So if you're trying to maximize contributions before year end, you have a limited amount of time to make that happen. And there's a few situations I wanted to highlight where just in the past, we've seen some glitches or miscommunications around that. And those are if you've changed jobs during the year. So if you've been contributing to multiple plans, you might need to compare your final pay stub from the first job to a pay stub of the current job, and just put those together and make sure you're on track. The other would be if your 401k provider changed. So if you've been working at the same company, but within your company, they moved from, say, Vanguard to Fidelity or vice versa, there can be sometimes administrative hiccups there where the contributions weren't consistent all year. The same would go to if your payroll company changed. So if your 401k has been at the same place, but behind the scenes with human resources or HR, the administrator changed. Again, just making sure consistency. Another one might be if you're over age 50, or if you're age 50 or over, particularly if you turned age 50 this year, or you're turning age 50 later this year because of the catch-up contribution. Individuals age 50 and older can contribute more and get more tax deferral and more tax savings. And some plans are better than others at alerting people to that opportunity and staying on top of it. So those are just some of the standouts where if any of those circumstances apply to you this year, it's worth a second look. And if you're not sure that you're on track, get a copy of your last year-to-date pay stub, share it with your advisory team, and we can just do a quick double check with you. We're really good at making sure that things are the way that we think they are. And that falls right in with employer benefits.
Actually, Ed, sorry, I don't mean to interrupt your flow. I just wanted to just mention one more thing as it relates to retirement plans. You did a great job explaining about employer-sponsored plans and how employees can take advantage of retirement contributions into their various retirement plans. But what about self-employed individuals or small business owners? Obviously, there's plans afforded for them that they can take advantage of as well. And I didn't know if you just wanted to briefly touch base on those.
Yeah, I'm glad you paused me there, Jim. That's a really good point. For people who are self-employed or if you run a small business, so whether you file a Schedule C or whether you have an S Corp or some other structure, there's definitely other opportunities beyond the kind of traditional 401k, IRA realm. There's things we can look at like a single person defined benefit plan. There's individual 401k plans. So there's other structures that can help you. And depending on whether you're just getting started as a small business owner or whether you're well established and have employees. So that's really something that we haven't already explored that with you as a client, or if that's something that part of the reason that you're looking at Heritage is to get that type of advice. A lot of different opportunities there that requires more attention and a bigger conversation. But I'm glad you brought that up. So that's a big point that the self-employed persons have more opportunities, but also more areas where the details really need to be examined and take some time to do it.
Great.
I'll touch on just a couple employer benefits here that I think are important. The health savings accounts and flexible spending accounts. They're similar, but there's a couple of very important differences between the two. Both allow you to defer income into an account to use for expenses later, and you get the advantage of the amount you defer into them being excluded from taxation. And as long as the withdrawals are for qualified expenses, those withdrawals are also income tax free. The main difference is flexible spending accounts, or FSAs, are known as use it or lose it. And the big takeaway heading into year end for those is if you use an FSA already, you really need to make sure that you don't abandon any funds in the account because it's use it or lose it. The good thing about those is most plans have a couple outs where you can either spend money into the next year, or you can carry over a small amount year to year. So use it or lose it, but maybe not entirely. But every plan's a little bit different. So if you don't know how yours works, it's a good time of year to check on that. And if you have money to burn, but no immediate costs, FSAs have a lot of flexibility for over-the-counter expenses. So in addition to things like your doctor's visits or prescriptions, you can go to a Walgreens or a CVS type place and you can buy things that are over the counter and kind of stock up on things that you might not need right now, but maybe in the future, even things like thermometers or things that you might want for the home. HSAs don't have that use it or lose it, and they do have the advantage of being able to invest in the account over the long term. So that means that you might actually want to leave money in the HSA and let it compound tax-free for a very long time if you can afford to spend out of pocket for healthcare expenses. If either of those features are an option that your employer offers and you're not sure if you should be using them or if you're using it the right way, those are really good conversations to have with your wealth management team about how they fit in with your whole spending pattern, what might work for you.
Ed, Ed, I'm sorry to interrupt again. As it relates to health savings accounts, many of us have heard the term triple tax deferral. Would you mind briefly just explaining tax deferral is and how it pertains to HSA accounts?
Absolutely. Yeah, the HSAs are really powerful for people that can access them. And the triple tax benefit is that money that you put into them is a tax deduction. So it lowers your present day tax liability. The money that's put into them can grow invested in the HSA tax-free. And then when you withdraw money for healthcare expenses later, even in retirement, if it's for a medical expense, it's tax-free when it comes out. The other thing I'd mention there is, unlike a lot of other accounts that you use for tax savings, like a deductible IRA or a Roth IRA, there's no income limit on using an HSA. So higher income households that have already been phased out of other savings vehicles and might be facing other kind of tax related phase-in penalties like the net investment income tax or just higher rates in general. The HSA is one of the few things that does have a phase out. So higher income folks should pay extra attention to that opportunity if you haven't already. Something that applies potentially whether you're high income or low income is an IRA to Roth conversion. These can be opportunistic or strategic, and it depends really on what you think about the future. And we can help with our financial planning software get a sense of what your tax trend might be over the long term. So if 2023 is a lower than normal income year, it might be a good idea to consider an IRA to Roth conversion. Or if it's a normal income year, but you expect the future to be a lot higher in terms of taxation, that could be another opportunity. And also, if you want to leave more tax-free income to heirs or a surviving spouse, that could be another reason. The main takeaway there is the IRA to Roth conversion has to happen before year end to count for 2023. And unlike in the past, there's no reversals anymore. There used to be a rule a number of years ago that if you did an IRA to Roth conversion, and then as you're doing your taxes in early next year, you put things together and realize that maybe it didn't work out the way you wanted, you could reverse it and make it like it never happened. That rule doesn't exist anymore. So we just have to be a little bit more careful and do a little bit more planning to make sure that we don't create any unintended consequences with the conversion.
And just more of a comment than a question as it relates to Roth conversions. Roth conversions, as you know, are not for everybody. They're very client specific. It's based on your own situation. There's a lot of factors that can go into Roth conversions. So if you do have a question and you're on this webinar in regards to a Roth conversion, please feel free to reach out to your wealth management team and they'll be happy to address that with you. Or if you're not a client here at the firm and you have some specific questions surrounding Roth conversions, please don't hesitate to reach out. We'll follow up with you.
It's a great comment. I think we also do a good job communicating with our clients' tax advisors to make sure that we're all on the same page. And that's the other thing I'd insert there too, again, on the lines of communication about recommendations and goals and accomplishments, that all comes into play. I'll leave here with something that I wanted to put in mostly because of the confusion it can create about capital gains taxes. And if we take a look at this chart for just a minute, and I'll provide the context. One of the things that we hear quite a bit, and I think is even misunderstood with a lot of professionals in our industry, is that long-term capital gains are taxed at a different rate than most of your other types of income. And something that we hear that's misspoken is the idea that if you sell a stock or sell a mutual fund and realize a gain, that it will push you into the next bracket, or that it will be taxed at your highest bracket. And you don't want to sell something because it'll, get taxed at that high rate. That isn't really the way it works. And I think that's important context if we're talking about rebalancing a portfolio or selling a position to free up cash for something that we need. So just follow with me for a minute on this real quick, and then we can move on to the next topic. But if you look at the first chart, these are your federal income tax rates for 2023 based on your taxable income. So if you look at kind of the middle section for married filing jointly and go down to, say, the 32% marginal rate, where it's between about $364,000 and $462,000. So let's say we have a married couple, they're both working, they both make about $200,000 a year, and your taxable income is somewhere in that range. So you're paying some income at 10, some at 12, some at 22, and your marginal rate is 32,000. If you were to sell a long-term security, a stock or a mutual fund, and realize a gain of $25,000, that gain isn't going to be taxed at your 32% tax rate. It's going to be taxed at the 15% rate. Because if we look at that bottom graph, you'll see there's 3 tax rates for long-term capital gains. It's either 0, 15, or 20. And you really don't pay the 20% rate until your taxable income is well over $500,000. So for a lot of individuals, if you envision paying a tax of 24, 32, 35 on the gain, that's actually not the case. It's probably 15 or 20. So just something, again, to keep in mind when we're envisioning what's going on, thinking about any liabilities heading into the year end or anything that we're doing about our portfolio.
And as it relates to capital gains, are there any advantages that, our clients or people on this webinar could take advantage of if they had, for example, a low basis stock or security with a very high capital gain, and they potentially wanted to donate that? Are there strategies that they can take advantage of?
Absolutely. I think you're giving me the layup transition to our next topic that I was jumping
That's what I'm
ahead
here
of.
for, Ed. I'm here to give you these layup transitions. So I want to keep your flow going.
It's a good one, though. Something that we see a lot is what to do with a security that's appreciated a lot since we bought it. It could be a stock that was part of your employer compensation. It could be a stock that you were attached to, maybe something you received as a gift. But that's something we see quite a bit. So let's get into that with this topic about helping family, friends, or charity. And, right off the bat, gifting appreciated securities instead of cash. So if you're able to itemize your deductions on your tax return and you give to charity and that's part of your deductions, you can typically take a deduction whether you gifted cash or whether you gift a security in kind. You can transfer a stock or a mutual fund directly to a charity. But if you give cash and you had an appreciated security, you might be missing an opportunity, because when you gift the security, you can get a deduction for its market value, but you might also then avoid the gain that you would have realized had you sold it. So there's a lot of instances where we don't see proactive advice being given to new clients or prospects that we meet with, where they gave cash to charity and they sold the security and paid a tax on the gain. And they could have just gifted some of the appreciated security. So that's something that we watch out for. And one of the really effective ways to do that is with a donor advised fund. And this is just a very simple image of what it looks like using a donor advised fund. So you can give cash or an appreciated security, but you get some of that leverage when you gift something that's gone up in value. And you can take that security, you transfer it to a donor advised fund. That's your deduction. That's what your tax benefit is. You can then leave it in the donor advised fund and let it grow and invest it, and then grant to charities over time in pieces. So this works really well where, let's say, you have a position that's worth $5,000 or $10,000 with a very large gain, and you gift to charity, but you don't gift $5,000 or $10,000 a year. Maybe you only give $500 or a couple thousand a year on average. If you want it to be strategic, you could transfer that entire position to the donor advised fund and get a kind of outsized charitable deduction for that tax year. But you don't need to move the whole thing to your charities at once. You can get the tax deduction all at once and then grant $500 to a charity in 1 year, $1,000 to the charity in another year. So the timing of this, when you're maybe approaching retirement, or maybe you expect your income to change a lot, using the donor advised fund to kind of give you some advantages about low income years, high income years can be very strategic. So if you've been giving to charity, if you're thinking about giving to charity, if you're reluctant to give a large amount all at once, but you'd like to develop a plan, a donor advised fund could be something to talk to your advisory team about. I think it's a tool that a lot of clients have used. They have some administrative advantages as well, kind of easy to keep track of what you're doing rather than a lot of small charitable gifts all at once.
Ed, real quick, I have a question that came through as it pertains to this. Should I gift appreciated securities to a donor advised fund or use a qualified charitable distribution from my IRAs? We get that question a lot from our clients. I know that you're well versed in this area as well.
Yeah, common question. There isn't necessarily a go-to answer. It can be very client specific, but I'll walk through kind of how we would think about it. Number one might be, are you able to itemize your deductions? That might be the first one. Since tax reform at the end of 2017, we've seen a lot more people not being able to itemize your deductions. So that doesn't mean that you shouldn't gift to charity from cash or securities. It just means that if you're trying to do it in a tax optimized way, you might be making a charitable gift that you're not actually getting a deduction for. Whereas if you're age 70 and a half and over and have an IRA and can use the QCD, it doesn't matter whether you itemize or not. That's one of the advantages of the QCD. It just, whatever you take out of your IRA and transfer to a charity in that way, that income just doesn't show up on your tax return. So that might be the first thing we take a look at. And I think the other thing we take a look at is in terms of if you have an appreciated security, what does that look like? What is the percent gain? What is the dollar gain? Is it a very large portion of your portfolio? And we might want to reduce it as the size of the whole because it represents a outsized specific risk and we're doing it for risk management. Is it another option to consider? But these are things that we can look at. We have fairly sophisticated tax planning software that we can use internally to run some pro formas and see if there's a big dollar difference. And if there isn't a big dollar difference, then it might come down to what's more administratively convenient or what's got the path of least resistance to get the problem. On the QCDs, one thing that's new this year is that individuals who are able to do QCDs can now send some of their QCD to a charitable gift annuity. So this is a little bit different because with a donor advised fund or with a regular QCD, you're deciding how much you'd like to give to charity, trying to do it in a tax efficient manner, and what you give is gone. With a charitable gift annuity, you get some of it back. So what you give to the charity, they're able to use it, but you get a little income stream in return. So for some persons who want to be charitable, but maybe aren't comfortable releasing the funds entirely to the charity and want something in return, a charitable gift annuity might be an idea. And whereas a new rule this year exists with the QCDs, it's something else to look at. We have a pretty lengthy blog post about that new strategy on our website. So if that's something of interest, you can look there or ask the wealth management team that you work with for a link to that article and see if it piques your interest.
Ed, just to backtrack for a second back to donor advised funds and QCDs in particular, we do have a lot of clients that will ask us on a regular basis, can I take a piece of my minimum required distribution this year and take a QCD and send it directly to my donor advised fund? If you wouldn't mind just answering that question, that's a popular question that we get on a regular basis.
Yeah, you're right. I think we get that a few times a year, every year. Unfortunately, the answer is no. you cannot send any QCD to a donor advised fund. It's been an item of discussion in Congress off and on for a number of years to try to make that something that you can do, but you cannot. So we'll certainly have that as a headline item if it ever does change that rule. I'm sure that will be widely discussed if it does, but at the time being, you cannot do that. Unfortunately, you don't have that flexibility.
Great.
The next thing I had was annual exclusion gifts. So shifting gears for a minute, the items beforehand, we've been talking about gifting to charity. Now I'm talking about gifting to individuals. So not charitable giving, but helping friends and family. So the annual exclusion gifts is the amount that the IRS says that you can give to somebody else before you might have to file a gift tax return. And that doesn't necessarily mean that any gift or estate tax would be due. It just means the IRS wants you to start keeping track of it. So to avoid filing a gift tax return, a lot of individuals that want to help family members stick to the annual exclusion amount to make it easier to accomplish. There's a few things that are exceptions to that rule, and that's what I wanted to highlight. And when you're thinking about helping somebody else and you're going to write them a check or transfer them securities, you can potentially increase your gifting to that person in two ways. One is tuition payments that you make directly to a school don't count towards the annual gift exclusion. So if there's someone in your family who goes to a private school, you're helping a grandchild, for example, with a private education, if you pay the school directly, you can avoid having that count to the annual exclusion. The same applies to healthcare expenses, but the big takeaway is both of those have to be direct. So you can't write a check to somebody for them to pay tuition or for them to pay healthcare. It's got to go direct to the provider. The thing to remember, though, is for 529 plans, for college savings plans, those contributions do count towards the annual gift exclusion. So if you're helping a family member save for college, even if it's your own child, those contributions do count towards the annual gift exclusion. So something to keep in mind there. The big benefit in leveraging the annual exclusions is that a married couple can double up. So it's $17,000 per person per donee. So if you're a married couple and you're saving for a child, that means that if you wanted to max contributions to a 529 plan without filing a gift tax return, you could do $34,000 in 1 year. There is a special exception that if you really wanted to fund a 529 plan in advance for someone, you can do up to 5 years worth of annual exclusions all at once. But that's a strategy that I would definitely suggest talking to your wealth management team about and thinking about the pros and cons of doing that. And this is the annual exclusion for 2023. If you want it to count for 2023, it has to be done by calendar year end. If you're thinking back to that slide about savings and cash flow and expenses, there's a good chance that the annual exclusion will increase for 2024, but those amounts haven't been released by the IRS yet. Those usually come out this time of year. I would expect us to know in a matter of days or a week or so. So if that's something where you're trying to maximize your gifts and you're thinking about year end and next year, stay tuned to see if that goes up potentially to $18,000 per person per donor. I mentioned 529 plans in there about annual exclusions counting towards 529 plans. A couple quick takeaways on these. If you have a 529 plan that you're using for education expenses already, you're really supposed to take the withdrawal from the plan in the same year that the expense was incurred. So if you know that you have a bill upcoming in the next couple of months before the end of the year, try to match a withdrawal so it hits at the end of the year as well. On the other hand, if you know you have an expense that's due in January of next year, try to wait until January to take the withdrawal. They're really supposed to be matched up in a calendar year. The number of things that you can use a 529 plan has really expanded over the last few years. So I'm not going to go through the qualified expenses list. There's a few things that you can't use a 529 plan for. I think the one that we get asked most often is travel expenses. Can you use it to fund taking a plane, a train, a car? If you're visiting a college, can you use it for the expenses of touring colleges? You cannot, unfortunately. That's probably the one that would be most helpful for a lot of people, but that door hasn't opened yet.
Great. Ed, there's a question that came through. It's somewhat of a loaded question, so bear with me. What financial planning strategies do you see clients often having neglected before working with you? I think I can help you a little bit with that, but just while you're putting your thoughts together, a few of the things that we see is many times when clients come to us, their assets are all over the place. They don't have a great idea of where the assets are held, how they're registered, whether they should be taking minimum required distributions or not from their retirement accounts. Are they maxing out their retirement accounts in the case of if they're still working or not? Their estate plan may or may not be completely up to date based on the most recent updated legislative changes. There could be potential tax planning strategies that they could take advantage of in order to reduce their taxable income in certain years. Those are a few that I'm just thinking off of my mind. Ed, are there any other strategies that you're seeing when we're sitting down with a client for the first time and that pop out to you on a pretty regular basis?
There's a lot.
Told you it was a loaded question.
Yeah, it's definitely it's a good question. I think it shows our value as advisors, our value as people who have been trained to care a lot about all the details of a plan. That's kind of our mantra. I think what I see in working with teams a lot with newer clients is that pieces of a plan have often been done. Someone might have reviewed life insurance needs with an insurance agent. They might have done an estate plan with an estate planning attorney, but typically no one's connected all the dots. So they might have an estate plan, but they might have account ownership, title, and beneficiary issues that aren't consistent with the plan. They might have life insurance, but their situation with the number of kids they have and the income that they earn might be completely different than when they bought that insurance, and it might not fit their needs anymore. So I think that's one thing I see quite a bit. Pieces of a plan, but not a real cohesive plan. Nothing that projects out income, expenses, taxes, estate planning, your house, your mortgage, the way that we do in a really comprehensive way. And then in doing so, that's when we uncover all the little finer points of maximizing retirement plan, contributions, the employer benefits you might not be using, whether you're gifting cash to charity and could have been gifting appreciated securities. So those are themes that I think are common, really, really common. And I think we always find something. I think that's kind of the good news of people working with us is we almost always find something. Let's wrap up on a few quick notes. But these are a little outside the norm of financial planning, but things that I think are helpful to a lot of people we work with. Checking your credit report for errors. You can get a free credit report online and almost anytime that you want. A lot of individuals have errors on their reports. It's a good thing to do heading into year end, the beginning of the year, if we haven't already. The site you can do it is annualcreditreport.com. And you used to only be able to do this once a quarter, but now you can do it every week. I don't think that you need to do that, but it just means that it's an easy opportunity to get a credit report and take a look. If you're not sure what it means when you get it, get a copy to your wealth management team and we can look at it together. The other one is expiration dates on IDs. Just think about your license, your passport, especially with the potential for government shutdown in the news. If you're planning on traveling anytime in the near future, making sure that your passport is up to date is a good one. Searching for lost property. This is a snapshot of if you live in Massachusetts where you need to go, find massmoney.gov. But virtually every state, the treasurer of that state has a website where you can easily search for lost property. Typically these aren't big sums. They're typically, $15, $20. But a lot of people have items out here, and maybe you can get a free lunch out of it. I was holding a surprise for you, Jim, which was I couldn't help myself before we started the webinar, and you have something on this website. So when we're done, you should go claim it, and you can treat me to lunch sometime when you get whatever it is.
Is all that money that you just listed there mine?
I'm not going to calculate the percentage, but
Okay.
we'll see what it is. But again, the low hanging fruit, just go search, see if there's something there. The tools even give you the ability to search for other people and shoot them an email if you see that they have something. So if you have, young adult children at home, or if there's an elderly person that you care for, you can look for other people and kind of alert them to the fact that something's out there. And then kind of lastly, children turning 18. We don't often think of maybe 18 or 19-year-olds as adults necessarily if they're still at home and in college and we're funding, all their expenses. But depending on the situation or the jurisdiction, an 18-year-old could be an adult in some circumstances. And if you have someone in your household who has turned 18 or will be turning 18, it might be a good idea just to think about some kind of basic emergency planning documents. So if you think about things like a durable power of attorney or a healthcare proxy, if there was an emergency or an unforeseen circumstance, you'd really want to make sure that you'd be able to do the things that you would think you could do for your child, and you just wouldn't want some kind of arbitrary rule to get into the way of doing that with them. So maybe time for some just very basic estate planning to make sure that you don't run into any issues there with your kind of kids who are adults, but not quite really in your mind, but something to keep an eye on. And wrapping up, everything we talked about today, taking a second look at your goals, how you're doing, communicating how you feel about what you've done, setting priorities for next year, thinking about your cash flow, your emergency savings, looking at tax planning opportunities, especially around charitable giving, helping, friends and family falls into that too, thinking about the annual exclusion, and then just staying organized, keeping your files up to date, keeping your IDs up to date, taking a look at your credit report, your credit score, that type of thing. I think all of these we can help you with, but all of these are meant to be things that you can take away yourself and work on as well. And if there's a question that you didn't have time to ask, or if you have a second thought about these, as Jim mentioned when we started, reach out to us. You can find us online. You can email me. You can email your wealth management team. All things that, we're happy to talk about, things that we enjoy working on.
Excellent, Ed. Thank you so much. For everybody, in addition to the webinar today, we do offer a variety of different ways to help you stay informed. As Ed mentioned earlier, our weekly blog and bi-weekly podcast are two ways in which we can share timely information on various market events, planning strategies, legislative changes, and various other topics. However, not all of these strategies mentioned today are for everyone. And as we do wrap up, I'd like to invite anyone that has an interest in talking about the planning opportunities and strategies mentioned today, or simply about your own personal situation, to please reach out to us directly. If you're a client of ours already, simply contact your wealth management team. If you don't work with us, please use that contact information that you see right there on the screen, and we'll be happy to follow up with you. The follow-up email will also contain a link of the recording of today's webinar, so please feel free to share it with others. Lastly, as soon as we close this webinar, you're going to see a survey pop up. It's very brief. We'd greatly appreciate your feedback on today's presentation, as well as any suggestions you may have about future events that we can bring you. Thank you again for joining us this afternoon, and have a great rest of the day.